There are moments in history when everything feels stable, almost too stable. The numbers look strong, markets are rising, and the system appears to be working exactly as it should. But sometimes that sense of stability is not a sign of strength, it's a sign that something deeper is being ignored. In the years leading up to 2008, the global financial system felt exactly like that. To the average person, it looked like a period of growth and opportunity. Homes were becoming more valuable every year, banks were making record profits, and investing felt safer than ever before. It created a powerful belief that the system had become reliable, predictable, almost unbreakable. But systems don't fail when people are afraid. They fail when people stop questioning them. At the center of this illusion was the housing market. Owning a home had always been a long-term investment, but during this period, it transformed into something more aggressive. Prices kept rising, and with every increase, confidence grew stronger. People started buying homes not because they needed them, but because they expected them to increase in value. This created a cycle. More buyers pushed prices higher, and higher prices attracted even more buyers. It was a feedback loop driven not just by economics, but by human psychology. The longer it continued, the more it felt normal. And when something feels normal for long enough, it stops being questioned. Banks adapted to this environment quickly. They realized that rising housing prices reduced their perceived risk. If a borrower failed to repay a loan, the bank could simply sell the property at a higher price and recover its money. This created a dangerous shift in behavior. Lending standards became weaker. Loans were approved faster, with less verification. People with unstable incomes or poor credit histories were suddenly able to access large amounts of money. These were known as subprime borrowers, high-risk individuals who, under normal circumstances, would not qualify for such loans. But the system didn't see them as risky anymore because the system wasn't measuring risk properly. It was assuming that prices would always rise. And that assumption became the foundation of everything. What made the situation even more complex and far more dangerous was what happened next. Banks bundled thousands of mortgages together into financial products known as mortgage-backed securities. These products were then sold to investors around the world, pension funds, institutions, even governments. On the surface, this seemed like a smart strategy. By spreading loans across a large pool, the risk appeared to be diversified. Rating agencies reinforced this belief by giving many of these securities high ratings, suggesting they were safe investments. But underneath that surface, the reality was very different. Many of these bundles contained loans that were fundamentally weak, borrowers who could barely afford their payments. Loans were structured with low initial interest rates that would later increase sharply. The system had become layered with complexity, and complexity makes people trust what they don't fully understand. People stop analyzing it and start relying on assumptions. And that's exactly what happened. But while most people trusted the system, one individual chose a different path. Michael Burry didn't look at the surface. He didn't rely on ratings or market sentiment. Instead, he went deeper into the raw data that most people ignored. He examined individual mortgage loans one by one, looking for patterns that others had overlooked. What he discovered was not just concerning, it was a warning. He noticed that many of these loans had adjustable interest rates. At first, borrowers were paying low monthly amounts, which made the loan seem affordable. But after a certain period, those rates would increase significantly. When that happened, the monthly payments would rise sharply. And for many borrowers, that increase would be impossible to manage. This created a delayed risk. The system wasn't failing yet, because the real pressure hadn't started. It was stable only because the conditions hadn't changed. But Burry understood something critical. When those conditions did change, the impact would be sudden and widespread. This realization led him to a conclusion: the housing market was not stable. It was a bubble. And that bubble was built on assumptions that could not hold forever, but seeing the problem was only the beginning. The real challenge was acting on it. Burry decided to bet against the housing market, a decision that seemed irrational to almost everyone. He used a credit default swap, a tool that allowed him to profit if mortgage-backed securities began to fail. He was buying insurance against a collapse that most people believed would never happen. At the time, this decision looked extreme. Banks were confident, investors were making money. The market continued to rise. From the outside, everything looked fine, and that's what made it so difficult. Because when a system looks stable, betting against it feels like a mistake. For a long time, Burry faced intense pressure. His position required him to keep paying while waiting for the collapse. As the market continued rising, those costs added up. Investors questioned his judgment. Some demanded their money back. Others believed he had misunderstood the system. This is one of the hardest moments in any decision-making process. When reality hasn't caught up yet, even the truth can feel wrong. But Burry didn't change his position, because the data hadn't changed. And eventually, reality began to shift. Housing prices stopped rising, then they began to fall. At the same time, adjustable interest rates started to reset. Borrowers who had been managing their payments suddenly found themselves unable to afford them. Defaults began to increase slowly at first, then rapidly. The system started to react. Mortgage-backed securities began losing value. Investors realized that the assets they believed were safe were actually filled with hidden risk. Confidence began to disappear. And once confidence begins to fade in a financial system, the effects spread quickly. Because financial systems are not just built on numbers, they are built on belief. And when belief breaks, everything else follows. By 2008, the collapse was unavoidable. Major financial institutions failed, markets crashed. The global economy entered a period of crisis. Jobs were lost, homes were taken. Entire industries were shaken. The system that once seemed strong was revealed to be fragile. And in that moment, Michael Burry's prediction became reality. But the story doesn't end there. Because the collapse was not just a financial event, it was a moment of clarity. For the first time, people began to see how the system actually worked. Banks that were once seen as untouchable suddenly needed saving. Governments stepped in, injecting massive amounts of money into institutions. This created a strange contradiction. The same system that had rewarded risk-taking during growth was now being protected from its own consequences. And this raised a quiet but uncomfortable question. If the system fails, who really pays the price? The answer became visible very quickly. It wasn't just institutions, it was ordinary people. People who lost their homes, their jobs, their stability. People who had trusted a system they never fully understood. The crisis didn't just expose financial weakness, it exposed a gap between perception and reality. After the crisis, changes were made. Regulations increased, oversight improved, systems were adjusted. But systems don't change easily, they adapt. The structure remains even if the appearance evolves. New tools replace old ones, new markets emerge. New opportunities are created, but the core behavior, the reliance on assumptions, the pursuit of profit, the tendency to overlook long-term risk remains deeply embedded. And this is why the story of 2008 is not just history. It's a pattern. Because financial systems are not only economic structures, they are psychological systems. They move through cycles of belief, confidence, fear, and recovery. Before the crisis, there was confidence. During the crisis, there was fear. After the crisis, there was caution, and over time, that caution slowly turns back into confidence. And confidence, if left unchecked, becomes assumption, and assumption becomes risk. This is the hidden rhythm of every financial system, and it's why prediction is so rare. Because to see what's coming, you have to step outside that rhythm. You have to question what feels normal. You have to look where others don't, not because it's invisible, but because it's uncomfortable to accept. Michael Burry didn't just predict a collapse. He resisted a belief, and that's what made the difference. Today, the financial world is even more complex than it was before. New technologies, global connections, and digital assets have added layers. And with every new layer, the potential for hidden risk grows. Not necessarily in the same place, but always somewhere beneath the surface. Because every system, no matter how advanced, depends on assumptions, and every assumption carries risk. The next crisis may not look like 2008. It may not begin in housing. It may not follow the same pattern. But it will begin the same way every crisis begins. Quietly, not with a crash, but with a belief. A belief that things are under control. A belief that the system is stronger than it really is. A belief that this time is different, but history has a way of responding to that belief. Not immediately, not obviously, but eventually. And when it does, it doesn't ask whether people were aware. It only reveals whether they were prepared. And maybe that's the real story here, not the collapse, not the prediction, but the pattern. Because sometimes the most dangerous moment in any system is the moment when it feels completely safe. And maybe the real question isn't whether another crisis will happen, but whether we'll recognize it before it begins.